Hello everyone, Joe Follico for Insignia Futures and Options. In this video, I'll be answering 3 of the most common questions I get as a futures broker. Stay with me. I've been a futures broker for almost 25 years, and in that time, I've dealt with hundreds and hundreds of clients. I wanted to share with you the top 3 most commonly asked questions I get from our clients. Let's get started with the first question. How do futures margin requirements work? Many investors new to futures trading don't understand how futures margin requirements apply to the markets they are interested in. They understandably associate it with margin borrowing when trading stocks. When trading commodity futures and options, margin requirements are the funds you need to have available in your trading account to trade a particular futures contract. Think of margin requirements as a performance bond. There are 3 margin requirement levels most traders need to be familiar with: initial, maintenance, and day trade. For example, a market such as the Micro E-mini S&P 500 futures contract currently has an initial margin requirement of $1,232, a maintenance requirement of $1,120, and a day trade margin of $50. Let me define each of these. Initial and maintenance margins apply to position traders who plan to hold their futures positions for longer than one trading session. The initial margin can also be thought of as day 1 margin. This is the amount of funds you will need to have available at the close of the current trading session on the day you entered the position. Beginning with day 2 of the trade, the margin requirement will be lowered to the maintenance level. This is essentially in place to give the trade room to fluctuate without generating a margin call. Day trade margin is typically much lower than the initial margin. It represents the funds you need to have available in your account to hold the position for just the current trading session. Using the Micro E-mini S&P 500 futures contract again as an example, our current day trade margin is only $50. This means that from the time the current market session opens until it closes, you only need to have $50 per futures contract available in your trading account to trade this contract. This market is open 23 hours per day, Sunday through Friday. Let's assume you have a balance of $500 available in your trading account. Technically, you could trade 10 contracts with a $50 day trade margin. However, I would strongly recommend against doing this. That's because the margin requirement must be maintained at all times for the length of the trade. If the market were to move against you by just 1 tick, you would not have enough funds in your account to meet the day trade margin requirement and would then have a margin call. A margin call when trading futures means that you either have to immediately deposit funds into your trading account or liquidate open positions to bring your account back into margin compliance. I recommend that clients never use 100% of their available account balance for trades. Personally, I feel 40 to 60% is a much better usage of margin funds. The next question I often hear is, can other traders see my stop orders? The answer is yes and no. Let's start with the no first. I've had many calls from frustrated traders saying they stopped me out again or they're targeting me in my stop orders. These clients honestly believe that there is some secret group of traders out there who could identify individual traders and go after their stop orders just to make their lives miserable. Of course, this is not true. The reality is that most traders place their stop orders at obvious price levels. Many savvy traders know this, but they have no idea who's placing those orders, and they certainly aren't targeting any individual traders. This simply would be impossible. Yes, traders with a level 2 market data feed, which is available to all clients, can see the number of orders sitting at certain price levels. You don't have to be in some secret society to have access to this. However, this market data does not tell you who those orders belong to or if those orders to enter or exit the market. Stop orders are a good thing and should be used in conjunction with a solid trading plan for each trade you place. If you do get stopped out, learn from the experience and move on. Yes, there will be times when the market may drop to your stop price, take you out, and then turn right back up again. But there will be just as many times that the market will continue moving much lower than your stop price, and for this, you will be very grateful you had a stop order in place. What contract month should I be trading? This last question is pretty common for long-term traders. As any experienced futures trader knows, each futures market will have several contracts available to trade with different expiration dates, hence where the term futures contracts comes from. For example, you could trade crude oil with an expiration date 1 month out or with an expiration date 2 years out. Which contract month to choose can make this confusing to some traders if they have a long-term outlook on a particular market. For example, if you felt crude oil prices were going to rise over the next 18 months, you may think it would be best to trade the contract that expires 18 months from now. The problem with this is that there may not be enough trading activity or volume in a contract 18 months from now. The closest trading month contract, known as the front month, will typically have the most trading volume. As you start to go out farther in time, you will see trading volume in each month dropping. The problem with this is if you are trading a contract month with very little trading volume, it will be more difficult to get in and out at a reasonable price. Markets with low trading activity typically have wider bid-ask price spreads. The wider the spread, the larger the negative impact on your overall result of the trade. Front-month contracts will usually have the tightest bid-ask spread. This is what you should be looking for. I recommend that clients choose a contract month with a good amount of trading volume in it. If you have a long-term outlook, you simply exit the trade when the futures contract you chose is coming up to its expiration date, and then you enter a new position in the next contract month with sufficient trading volume in it. This is known as a rollover trade and is very common in futures trading. Hopefully this video provided some useful information about trading futures. If you do have any questions about any of these topics, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.